Welcome to The Explainer. Today, we are cracking open the playbook on one of the most powerful moves in the entire corporate world, mergers and acquisitions.
We're going to explore the high-stakes strategy behind the deals that literally reshape industries. These moves create market titans, and, well, sometimes they create cautionary tales. This isn't just about getting bigger for the sake of it, it's about strategic survival and sheer dominance. Okay, let's break down the playbook.
All right, here's our framework for today. We're going to tackle this just like a top-tier consulting engagement, moving methodically from the basic landscape and strategic options right down to the nitty-gritty mechanics of valuation and the ultimate impact of these massive deals.
Before we get into all the complex strategies, let's make sure we're all on the same page. We need a clear shared understanding of the core concepts. What exactly are we talking about when we say M&A?
At its heart, M&A is all about combining forces to achieve something you couldn't do alone. Whether it's one company buying another outright, two firms joining as equals, or just a really surgical acquisition of key assets, the goal is almost always the same: to create a stronger, more competitive beast with a lot more market power.
Now, it's absolutely critical to understand the distinction you see here. You'll see headlines use merger and acquisition like they're the same thing all the time, but in the boardroom, they represent two fundamentally different strategic paths. An acquisition is a takeover, plain and simple. One company consumes another. A merger, on the other hand, is supposed to be a union of equals.
In a true merger of equals, like the landmark Daimler-Chrysler deal, the original companies actually cease to exist. Both of them surrender their stock, and a completely new entity is forged, with a brand new stock issued in its place. It's a fundamental reset for everybody involved, creating a new culture and a new identity right from scratch. So, with that foundation set, let's move into the strategic playbook. This is where we explore why companies pick one type of deal over another to hit their goals. This is where the theory really meets the battlefield of the market.
Companies have a whole toolbox of M&A transactions they can use, and each one is designed for a very specific purpose, from a simple asset purchase to a full-blown market consolidation, or even an executive-led buyout. Let's see how these actually play out in the real world.
Just think about Amazon's purchase of Whole Foods. That was a classic, straightforward acquisition. Amazon knew they had to get into the physical grocery market, but instead of spending years and billions building a brand from nothing, they just acquired an established leader. Instantly, they bought its brand, its customers, and its entire physical footprint.
Then you've got consolidation, which is a move that's both offensive and defensive. The goal is to grow your market share, but just as critically, it's about eliminating a potential future threat. The perfect example of this is Facebook, now Meta, of course, buying Instagram. They didn't just buy a photo app, they bought the company that was capturing the next generation of social media users. They neutralized a huge competitor before it could really challenge them.
And in a management acquisition, or what's called a management buyout, MBO, a company's own executives buy a controlling stake. And the most high-profile example recently has to be Elon Musk's purchase of Twitter. He used a mix of his own money and a ton of debt to take the public company private, giving him total operational and strategic control, completely free from the pressures of public shareholders. Okay, so we've seen the what and the why. Now let's get into the how. The real genius, or let's be honest, the failure of these deals often lies in their architecture, how they're structured, and just as importantly, how they're paid for.
You know, the strategic relationship between the two companies really dictates the whole structure of the deal. A horizontal merger, like Marriott buying Starwood, combines two direct rivals to grab more market share and pricing power. A vertical merger, like Apple buying a key sensor supplier, is all about securing and controlling your supply chain. And a conglomeration, well, that joins two totally unrelated businesses, usually as a way to diversify.
So how is all of this paid for? Well, there are three main levers: using cold hard cash, offering up your own company's stock as currency, or taking on the target's existing debt. Now, in most of these mega deals, it's actually a complex cocktail of all three. And that financing decision isn't just a detail. It's a critical, strategic choice that has massive implications for risk control and the company's future financial health.
This brings us to the most critical and, honestly, the most contentious part of any deal: figuring out the price. Billions of dollars are on the line, and if you get this wrong, it can be absolutely catastrophic. Valuation is really a battleground of perspectives. The seller wants the highest price possible, and the buyer wants the lowest. Bridging that gap means you have to move beyond just subjective opinion and get into a disciplined, data-driven valuation. And while there's always some judgment involved, there are established financial methods to anchor the whole negotiation in objective analysis. Investment bankers use a whole toolkit of valuation metrics. They might look at PE ratios to compare a company to its peers, or EV to sales to get a sense of its revenue power. They might even calculate the replacement cost, what it would cost to build the target company from scratch. But for a truly fundamental analysis, the gold standard is the discounted cash flow, or DCF model.
A DCF analysis is just incredibly powerful because it's forward-looking. It asks one fundamental question: what is the total value of all the cash a company is expected to generate for the rest of its life, but expressed in today's money? It's really all about valuing future potential.
Okay, now the DCF process itself is notoriously complex, but the logic is powerful. Step 1, forecast. You project the company's future free cash flows, which forces a really deep analysis of its growth and efficiency. Step 2, discount. You figure out a discount rate, usually the weighted average cost of capital, or WACC. Just think of WACC as the company's specific risk level. Higher risk means future cash is worth less today. And step 3, calculate. You bring all those future risk-adjusted cash flows back to what they're worth today. This forces an intellectually rigorous debate about a company's true long-term value.
Finally, after the deal is signed and the champagne's been popped, what's the real-world impact? Let's analyze the ripple effect, focusing on the one group that ultimately judges the success of any deal in a public company, the shareholders. In the short term, the market's reaction is often pretty predictable, and it reflects the immediate financial shift. The acquirer's stock tends to dip a bit as investors react to the massive cost and the new debt on the books. On the flip side, the target company's stock typically jumps, because the buyer almost always has to offer a big premium over the current market price to get shareholders to sell.
But the long-term strategic bet is on synergy, that powerful idea that 1 + 1 can equal 3. If the deal is truly successful and the integration after the merger is handled perfectly, the combined companies should be more profitable and efficient than its individual parts ever were. That leads to better performance and higher returns for all the shareholders of the new company. That's the strategic dream.
However, there is a very real risk, especially for the shareholders of the acquiring company: dilution. If the deal is paid for with stock, the acquirer has to issue millions of new shares. This means the ownership pie is now cut into more slices, and while the pie itself is bigger, each individual share now represents a smaller percentage of the total company, which can reduce an investor's voting power and their claim on future profits.
So, what's the final verdict? Mergers and acquisitions are, without a doubt, one of the most powerful tools in the corporate strategy playbook. When they're executed correctly, they can accelerate growth, create market-defining titans, and generate incredible value. But as we've seen, they are also incredibly complex, high-stakes moves. The line between a strategic masterstroke and a multi-billion-dollar gamble is razor-thin, and it all comes down to the quality of the strategy, the discipline of the valuation, and the perfection of the execution. The ultimate question every board has to ask isn't just, can we do this deal, but should we?